Okay. And then I just want to introduce our presenter for our investing group, who's Kristen Jacks. Kristen is a financial educator and the founder of Money in Your 20s. Kristen studied financial planning at Boston University's Center for Professional Education. She started her career at Kiplinger's Personal Finance magazine and later worked at Mutual Funds magazine. Kristen is also a graduate of Duke University. And tonight she'll be talking about why did that stock price move. So with that, I'll give it to you, Kristen. Thank you.
Oh, great. Thank you so much. And thank you to Greenwich Library for hosting these discussion groups every month. We've had a great following. People seem to really enjoy the information. And at the end, we'll remind you about the one coming up in April. So welcome, everybody. This is Why Did That Stock Price Move? Which is, by the way, kind of a dense subject and a controversial subject. Very, very smart people disagree. There are some kind of fun debates out there with the guys at University of Chicago arguing with the guys at Yale and things like that. So it's a lively debate. It's a dense debate. And I don't want to get us too much into the weeds. So why don't we start out with something. So actually, let's start out with a disclaimer, because I'm going to mention some stocks here, and I just want to make sure that everybody understands that this webinar is for educational purposes only. It is not intended to provide investment advice, and none of the investments mentioned in this discussion group are recommended. Many are not suitable for the average investor. So if you plan to invest, you are urged to consult an advisor who is aware of your unique needs and situation. Okay, so we're going to start with something easier, just to orient ourselves to, when we try to figure out why something goes up, something goes down, like our weight. We have all experienced that, we learned probably at a young age that it's all about the calories. Then as we got older, we probably heard about different theories of, how our hormones are, whether or not we have too much of a hormone or too little of a hormone, what's going on with enzymes, the quality of our sleep. There are all these factors then that we start to hear are maybe amplifying the effects or decreasing the effects of weight gain. So a subject can become very complicated. What's the observable result of, getting fatter or getting thinner? And it seems to really weigh, more heavily than just calories. You need to go beyond just the calorie explanation. So if you can imagine like that for yourself and how you have interpreted weight loss or weight gain, then you can kind of understand how there are different factions out there discussing, this concept of why does a stock go up or down. There are people who feel very strongly in one direction, who won't listen to people who feel strongly in an opposite direction. So, if you've had that experience, then you are ready to sort of navigate through how people argue over why a stock might go up or down. But before we dive right into that, we have to remember that, when stocks are being bought and sold in sort of like an auction fashion, there is really the price is just where, supply and demand meet. And the price of a stock at any one time is really just the last trade of that stock. So supply is like the number of shares that are available. They're the number of shares that are actually outstanding and being traded, which is a little complicated because that's the float. So the shares that are actually available for purchase is slightly different than the total shares outstanding. But we don't need to get into that right now. But for every stock, there's a certain number of shares that are available to be traded. And then there's the demand for it. And if the demand is high and the supply is limited, that'll really boost the price. So most people are pretty aware of this sort of supply demand curve, and then the price is like kind of that meeting in the middle at any one time. So what we're really trying to figure out, when a stock moves, it's like, well, what was either boosting or suppressing demand or supply? And it's really infrequent that we're talking about a supply issue because, however many shares of stock are outstanding, that doesn't change very often. That if it changes, that's really newsworthy. So the amount of shares that are available to be traded, that's usually, not moving. I mean, every now and then you will hear about a company that needs to raise money, so they issue more stock. And that dilutes, the ownership for the people who already own. That's bad news for the people who already own. That will almost inevitably make the individual share price of the stock go down. And then sometimes you hear about stock buyback, which is actually good for the people who already own the stock, because the number of shares that are out to be traded is going to be reduced because the company is buying back shares. So that will usually boost the price. But things like that, new shares being issued or the buybacks, those are pretty rare events. So we're usually not talking about a supply situation. We're usually talking about a demand situation. So what is boosting or curbing demand for a stock? That's really what's going to move the price. So either the demand has fallen or the demand has risen. And these are the factors that people argue about. And the first one, the fundamentals, this is like the calories of weight loss, okay? You don't get a lot of people saying that calories are completely irrelevant, right? So you don't get a lot of people saying that the fundamentals, the actual financials of the company, the profit, the cash flow, the debt level, you don't get a lot of people saying that doesn't matter at all, right? But you get people arguing that that's only a piece, and how big is that piece? How much does that piece impact the price of the stock? And that's really where a lot of the argument lays. And the next one down, the technical factors, I think might surprise you, because there are some people out there, they're called technicians or chartists, and all they do is look at the price and the volume and the time around the stock. So they sit with charts and they watch how this particular stock is behaving, how its price is moving over time. And some people say they literally do not care what the stock is. And I find that hard to believe, that they would only look at a chart and look for certain patterns that are bullish or bearish. But supposedly like a pure chartist or technician will do this. But these are the technical factors, and technical factors really just look at price action and volume. So, sometimes a stock, it's trading at a certain price, but not many people are participating. Maybe for the day, it's like 500 million shares changed hands, where as a normal day would be 2 billion shares. So volume is really, and volume is always compared to like an average of what's the average volume of shares trading hands. But in any case, there are these people out there that are technicians, and they think that the price action of the stock is extremely important to how the stock is behaving in terms of price, more so than fundamentals. And that's kind of an interesting assertion, and we'll get into what they look at and kind of the fun stuff they look at, like candlestick patterns. Then there are macro factors, and a lot of people believe, they can acknowledge there are macro factors. We're seeing a lot of that now with the rise in interest rates really affecting the stock market. But again, it's like, how much, and would a macro factor be much, much, much more important than fundamentals? Would it, or there are people who don't look at technical factors at all, and they would say that macro, it's only fundamentals and macro. And then you have people who really get into the human factor and the behavior factor, and that if a stock is moving, that it's not an entirely rational action. You've got human emotion involved. You've got fear and greed. You've got, social contagion. You've got social proof. You've got all of these factors, and then you really get into some arguments. Then you have some purists who believe in the efficient market theory, and out of Chicago, who are like, that is just bunk. That is garbage. And then there are other people, a guy, Richard Thaler, who just won the Nobel Prize, who also works at Chicago, who is probably one of the most famous behavioral economists out there. And he's like, it's not bunk. And in fact, much more can be explained by human bias and human emotion and things like that than the fundamentals. So it's a really interesting debate. And then there are just other factors that have to do with all sorts of things. And just so we don't get too bogged down and we keep this lively, I was going to start with some of the other factors just so you can have some quick hits of like, oh, I totally see how that moved. And, you know, let's just keep it going, keep our blood circulating and not get bored and not get bogged down in theory. So let's just start with one of the others just because it's more fun. So one that you probably have heard of, especially if you covered any of the GameStop meme stock craze, is short covering. So, you know, there are people who are long stocks and there are people who are short stocks. And being long a stock means you own it. You just own it outright and you're hoping the stock is going to go up. You really wouldn't own a stock and hope it goes down. So you're long the stock, you own it, you hope it goes up. Shorting is different. Shorting is you see a stock out there and you've decided from your own analysis that it's overvalued and you think that the price should come down, whether you're using fundamentals, whether you've looked at profit and loss and debt load and all those things, whether you're looking at macro, like the interest rates are going up and a certain company has a lot of debt and you think that that debt's going to just become much more expensive to them, you know, if they have to roll it over into new debt. So whatever formula you're using, or you're a chartist and you're just looking at price action, you see a certain pattern that based on previous technical indicators, you think the stock is going to go down. So how does somebody make money betting a stock goes down? Well, it's easy to understand how someone makes money. If they own a stock, they make money if it goes up. But how do you make money? How do you even place the bet that a stock is going to go down? And that's what shorting is all about. So you look at a stock and you think it's going to go down. And so you can, with the help of a broker, short the stock, which means you borrow the stock and you immediately sell it. But at a certain point, you're going to have to return what you borrowed. But you think that's no problem because you borrowed it, sold it, and you are sure that at a later date, you're going to be able to buy back those shares at a significantly lower price. So this makes perfect sense, right? So I buy a stock, $10 a share. I borrow it. No, I didn't buy it. Excuse me, I'm shorting it. So I didn't buy it. I borrowed it, $10 a share. Immediately sell it. I borrow it, immediately sell it. I know like 30 days from now, I'm going to have to return it, but I'm thinking 30 days from now, that stock's going to be $8. And so I'm going to buy it out in the market when it's $8 and then return it the way I was supposed to. Well, that doesn't always work out because now you've borrowed something, you've sold it, you no longer have any of it, and the stock starts to climb. And you know, you can think about your predicament. It's like, well, it was a $10 stock, you know, maybe it goes to $11, maybe it goes to $12, but really like that stock could kind of conceivably go anywhere. And you are going to need to own shares because you have to return what you've borrowed. And that's the kind of the drama and the fun when a stock that's been heavily shorted starts to go up, because there are all these people out there that have borrowed the stock, sold it, then they're going to need shares at a later date and they're going to have to race to get those shares back. Well, then the stock was already going up. Now it's going up because there's demand for it. Because the people who want to cover their short, they want to make sure that they have the shares that they're going to need to return the shares that they've borrowed. They're sort of in a panic. And as the price goes up, that price action gets even crazier. So short covering can create these enormous spikes in a stock price because the people who borrowed it, you know, they were wrong about the direction. And they could get really hurt if they don't grab some shares and have enough to return for the time when they're supposed to return those shares. So anyway, that's short covering, and that kind of creates the spike. So there's this relatively new insurance company that uses artificial intelligence, and it's called Lemonade. I don't know why, but they think they're going to kind of revolutionize insurance. And you know, when you go to buy insurance, all you're ever doing is talking to a robot. But you know, how complicated could it be? Just you need car insurance. There's only a certain number of questions that should determine the price that you pay. So Lemonade got a lot of attention very early on. But then people thought, you know what, it's just not there yet. The whole AI thing, really being able to run a business that way, it's not working. So people started shorting the stock. And then right around August, there was this short covering situation where it's a stock that I own a small amount of because I like fintech, I like financial companies and kind of looking what's happening in the future. And all of a sudden it like doubled in a week. And I thought, what is going on? And the only explanation was the short covering because they didn't have news, their fundamentals, their profits, nothing got better other than the fact that they were a heavily shorted stock. And now the people out there who shorted it had to cover their shorts. Tax loss harvesting, that's another one that's just, it's very straightforward. People don't really argue about this. Kind of another reason it's fun to start with these is that they're not that controversial. A stock, if it's lost a lot of value in a calendar year, and the investors out there, there are investors out there that are allowed to, if they sell something at a loss, they're allowed to take that loss and use it to offset other gains so they can lower their tax bill. And that's all tax loss harvesting is. Someone, an investor or a group or whatever, they're going out there, they're looking and saying, okay, I'm going to have a tax liability because I have some gains. What can I sell to offset my tax liability so my gains are lower? Oh, this stock is really, really down from where I bought it. So one of the reasons it's tax loss harvesting is that you'll see that that's happening with stocks that have come down dramatically in price because, in theory, the person bought it higher, and that's how you know that they're taking a loss. Well, that, right around December, there's this deadline to get all of those trades in by the end of the year for tax purposes. So right around December, you'll see a lot of stocks. This happens to a lot of stocks where they were up more, a lot more in the throughout the year. But as they've declined, then the decline accelerates into December because people are using that stock to capture their loss, if that makes sense. So that's another one where not controversial at all, really. I don't know anyone who disagrees about tax loss harvesting, although someone might argue that you don't know for certain that explains all the loss in December. And of course that would be true. But, in tax loss harvesting, short covering, those are some reasons that you see stock prices move, and they're not that controversial. Momentum is another one. Momentum is just a fascinating phenomenon that sometimes, a stock will move. If it's going down, it will just continue to go down. And if it's going up, it will continue to go up. And it doesn't match the fundamentals, and it doesn't really match technicals or macro or anything. It's just its own phenomenon. So sort of like whatever's happening just continues to happen. So Eduardo Repetto is a fairly famous guy in the financial industry. And he had this quote just saying that momentum is fascinating because if you really study the movement of stocks, there's no explanation. It's just something that we observe. He says, we don't understand why it happens. A security that has extremely bad performance will continue to have, for some short period of time, bad performance. And a security that has extremely good performance will continue to have, for some short period of time, good performance. And the reason it's important to know about momentum is that if you own something that seems to have this very nice, steady pattern of going up, nice and steady, maybe hold on to it. If there's no volatility in it, if it's not having a bunch of bad days or a bad week, just let it ride. That's the advice of people in the business. And if you have something that's just steadily going down, well, if you have a very, very long-term time horizon and you think the fundamentals are good, you might just say to yourself, well, things that go down just tend to go down more. It doesn't mean that this stock is a loser, but you have to ask yourself, can I stomach that? Or if things that are going down tend to go down, am I desperate to get out? That's a very personal question, especially if you need cash, you don't need cash, what your time horizon is. But momentum is just something that kind of all of that investors should know about and understand that it is a truly observable phenomenon that's been kind of, noticed I would say now for decades. I think it was definitely noticed for the first time in the 60s. I would say. I think it was one of the original factors that was noticed, and it just continues. Okay, we can circle back to other factors if time allows, but I just wanted to get through, have some fun ones before we get too much in the weeds with the debate and the things like that. But here we are again. We're back to what's moving the stock price. Well, what's moving it is we are either there's either been a boost in demand, or demand is down, or why. So here's where we get into the arguments. You have the conservative, traditional, stick to the basics folks, and they say, well, that is only happening because of the fundamentals. And well, okay, what are the fundamentals? Well, the fundamentals are the things that you see in an annual report. The fundamentals are the financial statements. It's the cash flow statement, it's the balance sheet, it's the income statement. So the people who really know how to read those statements, and they're looking for profitability, they're looking for growth, they're looking at the debt level, they're looking at, depending on what the company does for work, what the company does in business, it's like, well, what are the inventory levels like, and have they increased or decreased? I mean, this is a real deep dive into the actual business, right? This is, how is this business operating? What are their margins? Are they profitable? And anybody who goes, really, I think all investors should understand. Anyone who's going to pick an individual stock, I think, should definitely understand fundamental analysis, and hopefully, know how to know how to download an annual report and know how to look at profitability, at least to maybe eliminate some glaring errors. Like you don't want a very, very high, price to earnings ratio. You don't want a ton of debt if you don't understand why there's debt. I mean, everyone can benefit from looking at the fundamentals. But so then you have that information, right? Well, that doesn't tell the whole story, because a stock price is based not just on a snapshot of what's happening now, it's based on assumptions of the future. So this is where people can debate what a stock is worth, because some people can have very optimistic assumptions. They can forecast 20 years into the future. They can look at what they see now with good profitability and good growth, and they say, I'm going to put together a model on my computer that says that's going to continue for the next 20 years. Well, okay, maybe. I mean, that's not a perfect science. Those are forecasts. Someone else could look at the exact same company and say, I'm going to use more conservative numbers. I'm going to say that their sales are going to grow only at 7%, not 10%. There are all these different things that you can do that arrive at the whole intrinsic value of the company, forecasted very far into the future. And coming at that value, but it's a numeric value. It's really talking about the cash flow of the company that's going to be thrown off. And it's really about how the company itself is conducting business, and whether or not it's going to be profitable and things like that, and how far into the future it's going to be profitable, and whether or not the future looks bright. All of those things, that's fundamental analysis. And once that analysis is done, and certainly institutions are doing this, hedge funds are doing this, insurance companies are doing this. When a college has an endowment fund, they do these things for every stock that they hold. They're going to have really a really intelligent deep dive into what they think that company is worth based on the fundamentals. But it's not a perfect science, and then people can disagree if something's been too optimistic or too pessimistic. But then there are the people who just say that's not even what's moving the stock, which, I don't know a lot of people who are like, I never look at the fundamentals, but it's amazing to me how people say that it's not that relevant. Of course, I would think that it is very relevant, but you should know the full debate. Okay, so if it's not the fundamentals, what else is it? And in my research, the technical side just blows my mind, because it's just I'm just not ingrained to think that way, but I'm just going to give it to you straight. Hopefully I'm going to do this justice. If there are any chartists out there, unmute yourselves and chime in. But, technical analysis is really just looking at how a stock moves in terms of price. in terms of price and volume over time. And the time can be all different patterns. I mean, in this particular chart, all these little blips, the green ones and the red ones, and they're different sizes, and they're different sizes for different reasons, and we'll get into that. But you're just looking at a pattern of a stock moving up and down in terms of price. And then the second chart where you see the four circles, that's sort of showing that in theory, it's showing that there's this resistance, or not resistance level, that would be above it, a support level, that the price of this stock seems to keep bouncing off of a certain area, a support level. So people who are chartists say, like, well, based on that, you can forecast that the price is just not going to go below that for any significant amount of time. I mean, this is really what they do. And then they have support levels and all these things. But this science to chartists and to technicians is really important to them. And maybe you've heard about candlestick patterns. But it's really, you can't read these charts if you don't know what a candlestick is. So, before we see these, there are red sort of rectangles and there are green rectangles. Well, what are those? And some are tiny and some are long. And each one is called a candlestick. It doesn't matter if it's tiny or long. And some are red and some are green. And here's what it means. So the green ones, for whatever that snapshot of time was, I've heard currency traders, people who trade on the Forex, that they look at charts as short as, like, I want to see each candle is just 5 minutes. That's a little crazy. But for this particular exercise, let's just say the chart is 1 day in the market. Each candlestick is 1 day in the market. So then the candle is, what was the range in the price, right? So if it's a short, like stubby little candle, that means the price didn't move that much. If it's a long, elongated candle, that means there was like a big range in the price. And if it was green, if it's noted green, that means that the price that day went from lower to higher. That wherever the price opened, it closed higher than that. So the price went up. If it's a red candle, that means that the price went down. So, if it opened around $8 and it closed at $7.70, you're gonna get a red candle, it's down for the day. So if we're going back here, a chartist will look at this price action over time, and they'll also look at volume. I'm not really showing volume here, but these chart people really get into it. They look at how many people were involved when this candle, got tall and was green and things like that. So each one is a day. And so the people who really know how to read these things, they're looking for certain patterns, certain things that they go, oh, wow, that's an indicator. Okay. So believe it or not, you have these candles, and then they have these, patterns that they've named. So one of the patterns is the engulfing candle. So you see what is circled here, and you can see that there were red candles, there were green candles, there were stubby candles, there were long candles, but all of a sudden there's this really long candle, and an engulfing candle means that it is long, it covers the whole range of the day before, whatever that price range was. The price was lower than the day before and much, much, much higher than the day before. And that's an engulfing candle. Okay. So apparently, according to people who know how to do this, they say this is a very bullish sign. And they say something which is pretty shocking, that they say you can be confident the price is going to go up. They're going to marry it to a few other things. It's not very often that they just look at one engulfing candle and they go, oh, I figured it out. They're also going to look at volume and some other things. But it's amazing to me. They don't really care which company this is. It's not about earnings. It's not a news release about sales. It's just they see this pattern and they believe they can predict that the price is going to go up. So you just deserve to know that. I never look at charts. I've never made this part of my analysis, but if you if you read Investors Business Daily, if you listen to Investors Business Daily podcasts, you will be amazed how often the articles are written by a chartist, or the guest is a chartist. is a technician. So that this is really what technical analysis is. It's only looking at price, action, volume, and time. And I should say that if you have a question, then definitely leave it in the chat, because we will cover all the questions that you leave in the chat. So believe it or not, some of the most successful investors of the world at least incorporate charts and technical analysis in buy sell decisions. So I heard recently when Ken Griffin of Citadel was giving testimony before Congress, there is a technical indicator called an anchored VWAP, I think it's called. But anyway, the VWAP is like volume weighted average price. Okay, so you've got your volume, you've got your price, it says you've got nothing else. And he's saying that like about 30% of his buying decisions were based on these technical indicators. And he's an extremely successful person, managing a lot of money. So there you go. Sometimes there are people out there who will argue the price moved only because of the way the prices moved in the past. I don't buy it, but it's out there. All right, what is boosting or curbing demand? And it's the demand that's moving the price. So what about the macro factors? Okay, well, I tried to use an example that I think most people can relate to, like a big old macro factor. So macro factors, there are a lot of, out in the world factors that, macro meaning it's not specific to the company. It's happening out in the universe. I mean, war in the Ukraine is a macro factor. But one thing that really seems to affect some stocks way more than others, it's a real unique macro, is interest rates, because there are some companies that have a ton of debt, and there are some companies that have very little debt or no debt. Well, you can imagine if interest rates are going up and they keep going up, and the longer they're up and the longer they keep going up, it just seems to become this feeling that they're going to stay up for a long time. If you have a company like Verizon has $141 billion in long-term debt, that's a lot of debt. And servicing that debt, paying for that debt, paying the interest on that debt is expensive. And it's going to get a lot more expensive, unless they can afford to pay off their debt, which would mean profits from the company go to paying off the debt. Don't go to dividends, don't go to investing back into the company. Having a lot of debt in an environment where interest rates are going up is a problem, right? And so this is one of the ones where it just seems crystal clear that one reason Verizon stock is moving is a macro factor, and that factor is interest rates. So on, the green chart, that's the 10-year, okay? So that's the 10-year yield. That's the yield on the 10-year treasury. And if you look over the last year, you see it's just gone decidedly up, right? And on the right, the red chart, that's the price of Verizon stock. And it seems to really pretty well match that as interest rates go up, the stock of Verizon goes down. And plenty of pundits, plenty of people out there are making this point that the stocks that are very, very weighted down with debt are really getting hammered, and it's only going to get worse if interest rates rise. So you don't see the effect immediately, because a lot of people thought, okay, well, the rates are going to go up because we're trying to squash inflation, but the rates will come back down. But the longer that the rates stay up and the longer they keep getting increased, the worse it seems to get for these stocks that have a lot of debt. And the numbers are there. The numbers tell the story. Okay, my favorite, truth be told, I was a psychology major in college, and even though I was really good at math and I love math, the behavioral factors to me are very, very compelling when it comes to the movement in stock price. I'm definitely into the fundamentals, definitely care about the financial piece a huge amount, and I care about the macro, not so into the technical, but behavioral factors. This is the area that's starting to get a lot of attention. It was kind of poo-pooed early on, it's not scientific enough, emotions, all that stuff, blah, blah, blah. But now the behavioral factors are really coming into their own. But even from the very beginning, like Benjamin Graham is the father of value investing. So Warren Buffett at one point worked for Benjamin Graham and then wrote the foreword to Benjamin Graham's famous book, The Intelligent Investor. And so Benjamin Graham has been around forever, and he really taught people like security analysis. And when he was teaching security analysis, he was teaching the fundamentals, that you want to look at things also like, the dividend yield. And, but it was always numbers. It was always these metrics that were very financial. But Benjamin Graham also believed, he kind of had this character called Mr. Market, that he really tried to capture this sense that sometimes, the market is like too high when it's high, and sometimes it's too low when it's low. And you can do all of the fundamental analysis you want, and you can be really careful and look at financial statements, but sometimes you just have to understand that the market itself can behave in a manic depressive manner. And so from the very beginning, when, I think this book was, did it come out in 1949? I mean, we're going back a long, long time. People were talking about the fundamentals, but also sort of the unusual. There's this piece that's inexplicable, that's emotional, that's too high when it's high, that's too low when it's low, and that's the market. So the behaviorists come along, and all three of these guys if you Google any of them, if you listen to the podcasts where they speak, if you read their books, these are the Nobel Prize winners. These are the ones that are really saying, all this rational stuff, all the fundamentals, all that stuff, it's important, but it doesn't tell the whole story, especially when we get into extremes. So Robert Shiller of Yale he's really famous for writing. He didn't coin the phrase irrational exuberance, but he wrote the book Irrational Exuberance, looking at bubbles. And he would argue, it's interesting to me that there are people who are fundamental in nature, who believe in efficient market theory, who say there's just no such thing as a bubble. The price is always right. Stocks, reflect all the information. And, you can't say that anything's a bubble because maybe as the prices were going up, 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 it's just because all of the information was good, and all the forecasts were optimistic, but within reasonable bounds and things. And Robert Shiller says that is all false. It's good to a certain point, and then after that, you get sort of this herd mentality. You get people overreacting to the good news. You get people who there's a theorist called Cialdini who talks about how we influence each other and social proof, and how we start to play off of each other. So people are telling stories about stocks they bought and how much they've run up, and people kind of get into these manias and things like that. So definitely in the extremes, there's a lot of evidence that sometimes a stock is moving just because everyone's piling on, and it doesn't matter what the technicals are, and it doesn't matter what the fundamentals are. It's just sort of become a mania. And I think that's a really good point. And then Daniel Kahneman and Richard Thaler, they're also in there talking about, we just have these behavioral quirks. We're human beings. So we tend to have like a heuristic. It's like a shortcut, right? It's like when you have to make an important decision, you can have like very thoughtful, lengthy analysis, or you can have a rule of thumb and just kind of use that rule of thumb and go with it. And that's what a heuristic is. It's like a shortcut. It's a judgment shortcut, a decision-making shortcut. And Daniel Kahneman talks about, like, if you're going to buy a stock, like that's a pretty weighty decision where to put your money. And in his books, he just talks about all these biases that we have. And he didn't come up with confirmation bias, but you've definitely heard of a certain bias where somebody will, like, whatever they believe, they only see the information that confirms their belief already. So if they're, maybe a stock is moving, it shouldn't be moving, but people just seem to favor it, and it doesn't really fit with the fundamentals and things like that. So I'm really in this camp. I was in this camp from the very beginning when I read Ben Graham, because even before I read Ben Graham, I remember thinking, for the years I had been looking at the stock market, it always seemed bipolar to me. And it was so amazing to see that I would have said bipolar. He said manic depressive. So I think maybe back in 1949, they called it manic depressive. But the longer you watch a market, it does seem to have this feature of being too high when it's high and too low when it's low. And people do seem to pile on to individual stocks beyond the fundamentals. And they seem to bail out when other people are bailing out. And so that does seem like a human behavior. Does it go on forever? I mean, it depends. I mean, sometimes you get these really lengthy manias, but it's a little bit of the momentum mixed in. Yeah, so it's the fundamentals, but it's the momentum. It's all those things, which I guess is my point, that you can put this all together, and these are multifactorial explanations, right? Sometimes you can't isolate it. It's not just the fundamentals. It's not just the behavior. It could be the chart is right, and that's driving some people to buy. Then the stock goes up, and then the herd behavior kicks in. Actually, Schiller talks a lot in his most recent book about, I think his most recent book is called Narrative Economics. And he talks about that basically once there are stories out there and the stories become popular, that they just sort of feed on themselves. And it's the story itself that's driving the behavior, and it almost spreads like a contagion. And then I definitely see this with Tesla stock. If you are ever on Twitter and someone on Twitter says, okay, what's the stock for the long run? If you could only buy one stock, what would it be? If somebody who has a big following says something like that, it is amazing to me how many people tweet back Tesla. And this was, so Tesla crashed at the end of last year. It got all the way down to almost $100, and then very quickly raced back up to $200. And now the last couple of days have been bad. But that's kind of the thing with Tesla going so quickly from 100 to 200, it does seem to be this narrative, this thing that people like to pile into, because really nothing else could explain a stock movement like that. In any case, so that's what I got. We're going to circle back to the others, and we're also going to take questions, but I definitely want to make sure that everybody knows that the next investing discussion group is never chase returns. Probably the worst thing you can do. And it's definitely one of those things that the behaviorists say happens all the time. And we're going to look at some pretty dramatic problems that are caused when you do chase returns. We're going to talk about the experts like David Swenson, one of my favorites. He ran the Yale Endowment for years and years, had a huge track record. He went on to podcasts saying this is like the #1 problem that people have. So if you can make yourself be someone who would never chase returns, who could just look at fundamentals, then you will be a much, much better investor. So we're gonna use a lot of examples, a lot of experts, but that's a discussion for April 11th at 7 o'clock, and I'm sure that you can just go on the website to sign up for that. And just so you know, my email is kjacks@moneyinyour20s.com. I'm the author of Money in Your 20s. And if you email me, I always offer a free chapter of my book. Most people want the Taxes 101 chapter, but there's also the New Way to Save, which can be very helpful if you're trying to think, am I even ready to be an investor? Like, have I really gone through the process of figuring out, like, what should I do first? Should I pay off the credit card? Should I pay down my car loan? Should I have an emergency fund? So the New Way to Save is also a great chapter. I also have a chapter, I don't believe in budgeting the traditional way. It doesn't work. So I have a chapter that really helps you in like 5 steps, just come up with 3 allowances. So whatever you earn as an income, I just say, here's your income, now deduct taxes, now divide by 12, because we think monthly, now divide by 3. And you get at this number that very quickly gives you allowances for your rent, all your other expenses, and having fun and saving. So, all right, well, I'm going to check the chat, but I think we could also go back to some of the other, sort of the famous other things that might be going on. with why a stock might be moving. And okay, guys, chip in, and also if you're out there and you've had a personal experience of a stock moving, and it's, any kind of unique story, anything that you've noticed, this is supposed to be a discussion group. So, share your experience. They're all different sorts of things. I mean, I've heard from people that when, an index fund rebalances, so like, for example, we'll say there's like the S&P 500 is the index. Well, companies get kicked out of the S&P 500. Companies get added to the S&P 500. I know people out there who, just based on what's going to be added to the S&P 500 and what's going to be excluded from the S&P 500, they watch for that. And the minute they find out what's being added, they load up on it because they assume that it has to go up in price. The demand has to be increased because it's now going to be part of the S&P 500. And if a stock is being excluded, that's a stock that you should short. There are all really interesting strategies out there. There are other people who look at fund flows. So if you've personally had a situation with a stock moving, any story you want to tell, just add it. And any questions you might have, go ahead. Otherwise, I will. We only have a few minutes left. I will just keep, oh, Siobhan, did you want to say something? I will just keep talking about all these others. Oh, here's a question. With a company like Apple that seems to have forward momentum and good fundamentals, might one think that history is prologue? That's a really, really good question. Yeah. Now, you're saying that they have good fundamentals, and they probably do. I haven't looked recently, so I have not been I actually never do technology because I have no business doing technology because I'm really bad at it. But that's a really, why not? If the stock routinely goes up and it seems to have good fundamentals, that's how you become, that's how you make your decision as an investor. I would also, with the macro, I don't think they have any debt. So you start looking at like, what would be the macro headwinds? And I guess like if people aren't going to spend so much on iPhones because there might be a recession, I mean, that would be the macro part of this. But again, I don't give investing advice, but I'm just saying you're onto something there. You're on the right track. Anybody else? Anybody else? Okay, for the other, I don't know if I mentioned insider purchases or insider sales. That's another really interesting thing for people. If you're going to, certainly if you're ever going to buy individual stocks, you should get used to doing that kind of due diligence of, so by an insider, I mean like someone who is the chief financial officer, the chief operating officer, the chief marketing, someone in the C-suite. Those people have to disclose if they're buying or selling the company stock. And there are, again, people who really look for that as a signal. There are people who look for it as a buy signal. If they see that insiders are using their own money to load up on company stock, not just getting stock through options and things like that, they think of that as a very bullish signal. And they think, and then if the stock goes up, people will say, well, the insiders were buying it, and that led to other people being confident about it and things like that. So that's another thing that could move a stock price. Insider selling can have the opposite effect, as you can imagine, and it can be really dicey if someone, if an executive sells a lot of shares, and maybe they had a good reason, maybe they're going through a divorce, maybe they have to finance 2 households or pay for their twins are going to college or something, but it really doesn't matter. It's a very bad sign. It's a bearish sign, and that can bring a stock price down. Opinion on when the market correction will end. That's I have no idea. Yeah, I really don't even have an opinion. I looked for things like the December, the tax loss harvesting. That I felt was an artificial overcorrection. So in the end of December, it looked like the market was down, like things were getting worse and worse. And from my personal experience, I say, no, that's tax loss harvesting. So then when the market rebounded in January, I wasn't at all surprised because I felt like those stocks had been made artificially low by tax loss harvesting. So I was not at all surprised by the January jump. But could the market go sideways, go down? Absolutely. I have no idea. I mean, if all of a sudden the war in Ukraine ended, the market would just race ahead. So there are a lot of macro factors. If because of these bank failures, the Fed decides, they start to see how problematic it is to keep raising interest rates. And this is really interesting because you would think interest rates going up would be good for banks because they can charge more on loans. But the situation with some banks is that they bought bonds when bond yields were lower. And of course, when yields go up, bond prices go down. So now they're sitting on bonds that they can't unload without taking a big loss. So those bonds have lost value. And if you don't understand what I'm saying, you really ought to watch the myth that bonds are safe. That was one of our discussion groups. And all of these discussion groups live on the library website. I don't know, is it easy to find where they live on the website, Siobhan?
It is, well, it's right on our, so if you go to Greenwich Library, the YouTube page, that it's right up top. And
so just go to Greenwich Library, the YouTube page.
Yes, but also under the greenwichllibrary.org website, under Learn, there's recorded events, and you can find it. That'll take you right to the YouTube page as well.
Okay, great. Oh, Lisa Katz says thank you. Lisa comes to a lot of these things. Lisa, thanks for coming. It's always good to see you. And Kristen, what do you think? What type of index funds would be a reasonable, good, safe, long-term investment? Oh, definitely the S&P 500. That's what everybody says. Everybody. Now, some people say you should do the total market index. So that's like everything. But when you look over long stretches of time, the difference in return of the S&P 500, which is the top 500 companies, versus the about 3,000 of all the companies that have stock, it's not that big a difference. So I think S&P 500 is, if you're just looking for stable, normal way to go. Interestingly, though, so there is a product. This might be getting a little complicated, but the S&P 500 is cap weighted, capitalization weighted, and then there's a separate product which is just the 500 stocks, and it doesn't matter. So a cap weight means that the bigger stocks have a bigger share of the index, and because certain stocks have just grown mammoth, I actually don't like that as much because I think those stocks are overvalued. But maybe not, but an Apple is mammoth and it's not overvalued. So it's a little complicated. Maybe I'm saying too much, but I would go just with a regular weight, not a cap weight on the S&P 500. Oh, and Carolyn, thank you. Does it matter which S&P 500? The cheapest one. Definitely go with the cheapest one. Don't spend anything on an S&P 500 index fund. It's amazing how the different companies that offer it, it's all the same product. And then some people charge high fees and some, I mean, my understanding is Vanguard has to be one of the lowest. I don't know if it's the absolute lowest. T. Rowe Price probably has a really low one. Fidelity or Schwab, all those guys might be like, come on, we're really low too. I just don't know. I would guess the Vanguard 500. Yeah. Okay. So we got some good questions at the very end. All right, anyone else? Going, gone. Oh, thank you too. Thank you, Peter. Everyone have a good night.
Yes, thank you all for coming tonight. Thank you, Kristen, for your expertise. We always enjoy having you. And I guess if there's no more questions, then I think we're all set.
Great. Join us April 11th.
April 11th, yes,
returns.
You can sign up right on the Greenwich Library calendar. You can register right there.
Okay.
All right. Thank you, everyone. Have a good night.
Good night.